Hi traders, welcome to this video. Today I want to show you why you should avoid lagging stocks. So what is a laggard? A laggard is a stock which is continuously underperforming the S&P 500 or Nasdaq. It always depends to what the stocks compare. I always compare that to the S&P 500 and I use the relative strength indicator to see if a stock is underperforming or outperforming the index. I made a video about the comparative relative strength indicator, so please look into my YouTube channel. So here in my on my screen you see on top the chart of the stock, then you see the comparative relative strength indicator against the S&P 500 volume, and I also added the S&P 500 to the chart. And the first stock I want to show you is Abbott Laboratories. And you can see that the CRS indicator, the relative strength indicator, is going down. And this is the first sign that a stock is underperforming the S&P 500. You can see it very clearly because I also added here the S&P 500, and in the same period the S&P 500 is going up. And what is the price, or what did the price? The price was going sideways here in the period. So S&P 500 was going up, the stock was going sideways, and this is a clear underperformance. So I trade normally stocks, or I almost always trade stocks which outperform the S&P 500. So, and now look what happened here. The stock broke out in January 2020, so a few months ago, and it immediately reversed. And this is very typical for laggards. Lagging stocks break out when the market tops and then have very, very strong corrections. Because the thing is, a lagging stock is always showing that institutions are not willing to buy that, and institutions maybe distribute the stock or are not adding to their existing positions. And you always want to trade leading stocks, outperforming stocks, not laggards. Avoid that. And the thing is, let's come back to the breakout here. When did the breakout occur? It occurred as the S&P 500 was in the topping phase. So in the last weeks of the rally in the S&P 500. In that situation, the S&P 500 was well above its moving average 200. So in a less or more extended state, and in that the last stocks, really the stocks which missed the whole rally, then they break out, and in that situation the most breakouts failed. I want to show you some more examples. Snap, another good example. You can see here the relative strength is going down, price is more or less going sideways, S&P 500 is going up. And then the relative strength line picked up, so was rising a little bit. The stock made a new high, and it was a clear laggard because it happened when the market topped. And then you can see this breakout failed immediately, and the stock was or started a correction immediately after the breakout. PayPal, another very, very good example, because here you can see that the RS line was going down here and then was going up. So a little bit like a cup or a rounded bottom. But the thing is, the RS line was going up very, very slowly. And what you want to see is exactly the opposite. If you have a strong stock, the RS line is going up very steep and very fast and very decisive. And PayPal is exactly doing the opposite. And you can see that PayPal broke out here, and the the RS line was well below the last highs. And this is another indicator or another sign that the stock is underperforming. Normally you want to see that if a stock made a new high, you want confirmation in the RS line. You want that the stock also makes a new high. And this is not the case here with PayPal, and it shows you that the stock is lagging too. Square, another example, exactly the same situation. Here you can see that also, that there is. You can see that there is a long downtrend also in the RS line. And then here in the last weeks of the rally in the S&P 500, also the RS line was going up. I mentioned the stock here in the newsletter. So before it corrected, it was on my watch list in that situation, but I personally wanted to see some sideways consolidation here. And then a breakout that never happened, and you can see the same pattern here. Now I will come to another category of stocks, and these stocks are strongly underperforming the index. These are the real laggards. And you can see JP Morgan case. JP Morgan case, you can see it here from September, October. It was outperforming the S&P 500. That looked very good. It was in sync with the market. And then JP Morgan started to top before the market. That's often a sign that something is changing in the markets. If the stocks which lead or which led the rally, that they started to top. And here you can see this double top in the in JP Morgan case. And here is a very good example. You can see that the price is going sideways and the RS line is going down and very steep. And this shows you that something is wrong with the stock. In such a situation, if you see that the RS line is going down quickly and steep, and the stock price is going sideways or maybe is going up, in that situation you wanna be a seller. You wanna be a defensive, take profits. And what happened? The stock was corrected very strongly, exact. With the correction in the stock market. Another category of laggards is Boeing. It's not Boeing, sorry. Are stocks which continuously underperform the market. One example here is Boeing, and you can see that Boeing was in a downtrend. You never wanna trade a stock on the long side if the stock is on a downtrend. And the RS line confirmed this downtrend. You can see that the stock was or is underperforming the S&P 500 strongly. So the RS line is going down very steep. Stock is in a downtrend. And the S&P 500 was doing the opposite. So the S&P 500 rose and had a very nice rally. And then you can see that if the general stock market, in that case here the S&P 500, topped, then the real correction started with Boeing here. And that's the stock, for example. If you want to trade a stock on the short side, look for such stocks which strongly underperformed through a stock market rally and show signs of distribution and are very, very weak, are in a clear downtrend. And then in such a situation, you can short such a stock when the market topped. Okay, so to sum it up, avoid laggards in every case. So you always want to trade leading stocks and you want to avoid laggards, and especially avoid laggards when the market, the general stock market, rallied for some weeks or some months, because laggards always break out in the last phase of a stock market rally, and then all the breakouts fail immediately and a correction starts. So that's a lesson here: avoid laggards.